It appears that the decline of the US dollar has accelerated in recent times due to a shift in investor expectations regarding interest rates. The dollar had previously surged to a two-decade high in September, driven by the Federal Reserve's aggressive pace of interest rate hikes. However, several factors such as recession fears, the collapse of three regional banks, concerns about congressional infighting, and U.S. spending have contributed to its subsequent decline. One significant factor impacting the dollar's decline is the cooling inflation and the Federal Reserve's response to it. As inflation moderates, the Federal Reserve seems to be nearing the end of its current cycle of interest rate hikes. This shift in monetary policy expectations has led to a weakening of the dollar. While the Federal Reserve raised interest rates by a quarter point and suggested the possibility of another hike later in the year, there are doubts about whether the second hike will actually materialize. The central bank may decide to hold rates steady until inflation reaches its 2% target. This potential shift in policy could further impact the dollar's value. Moreover, as other central banks around the world catch up with raising their interest rates after the Federal Reserve's earlier moves, the relative attractiveness of the US dollar as the only game in town diminishes. This means that the dollar is approaching a more sustainable level compared to other currencies, according to experts. The decline of the US dollar can have significant implications for various aspects of the economy, including corporate earnings and investment opportunities. Here are some of the key points to consider. Many tech companies, such as Salesforce, Microsoft, and Apple, generate a substantial portion of their revenue from overseas markets. When the US dollar weakens, the exchange rate becomes unfavorable for these companies, as their foreign earnings are translated back into fewer dollars. This can weigh down their top-line growth and negatively affect their earnings in US dollar terms. On the other hand, a declining US dollar can act as a tailwind for tech companies' earnings. As the dollar loses value relative to other currencies, the revenue generated in foreign markets becomes more valuable when converted back to US dollars. This could support tech companies' earnings and contribute to their stock price appreciation, which, in turn, can positively impact the broader market rally. While the weakening dollar might benefit tech companies and other exporters, experts suggest that the positive effects on corporate earnings are likely to be limited. The dollar's decline might not have much further room to slide, and it's uncertain if the benefits will be sustained in the long term. The declining US dollar can also impact commodity prices, such as gold. As gold is priced in US dollars, a weaker dollar makes it cheaper for investors outside the US to purchase gold. This increased demand from foreign investors can push up gold prices, as witnessed by the rise of over 6% in gold prices during the mentioned year. The stance of other central banks, such as the Bank of Japan and the European Central Bank, can also influence the foreign exchange markets. Different central banks with varying interest rate policies can affect the relative strength of currencies, including the US dollar. The dollar's role as the world's reserve currency was established in the 1944 Bretton Woods Agreement, which pegged the exchange rate of all currencies to the dollar, which in turn was pegged to gold. This meant that, instead of gold, other countries accumulated reserves of US dollars. Today, the dollar makes up about 61% of all known central bank reserves, according to the International Monetary Fund. In addition, roughly 40% of the world's debt exists in dollars. This brings certain benefits to the US economy. The country issuing the reserve currency is not exposed to the same level of exchange rate risk that other countries are, and can also afford to borrow large sums of capital more cheaply. In the past, the US has been criticized for the benefits that its reserve currency status confers. Valéry Giscard d'Estaing, president of France between 1974 and 2981, chastised the US for receiving exorbitant privilege as a reserve currency holder. However, reserve status also has its drawbacks. These low borrowing costs can encourage public and private sectors to spend more frivolously, racking up debt as a result. The federal budget deficit is expected to reach around $4 TRN, or around 20% of US GDP this year. Because of its outsized role in global trade, the strength of the dollar has a significant impact on global economic growth. A strong dollar makes it more expensive for other countries to pay for imports, reducing demand and therefore economic activity. This leaves countries exposed to spillovers from fluctuations in the U.S. economy. Emerging market governments and economies are more vulnerable to foreign exchange risk, owing to a lower capacity to borrow and transact in their own currencies, said Cantrell. This can become a vicious cycle when foreign exchange depreciation makes debt repayment more difficult, possibly triggering financial or balance of payment crises. Last year, the former governor of the Bank of England, Mark Carney, suggested that central banks come together to create their own replacement reserve currency, to counter the destabilizing effects of relying on the US dollar. Cantrell explains that, as well as limiting countries' exposure to economic shocks in the US, a different monetary system could reduce the US hegemony outside the financial system. Especially when the USA's place in global finance is leveraged for American foreign policy interests. For example, in enforcing sanctions against Iran, this tests the patience of other actors in the system, including of Europe. China is also a vocal and proactive opponent of dollar dominance for this reason. This is especially true as China attempts to establish a regional network of infrastructure, technology, and trade independent of the USA, signified by the Belt and Road Initiative, he said. In conclusion, the decline of the US dollar's value, fueled by a shift in investor expectations regarding interest rates and concerns about inflation, has significant implications for various sectors of the global economy. While it may offer a potential tailwind to tech companies' earnings and benefit commodity prices like gold, the overall impact might be limited as other central banks adjust their policies and the dollar approaches a more sustainable level. The US dollar's role as the world's reserve currency, established in the Bretton Woods Agreement, has long been a source of advantages for the U.S. economy, such as lower exchange rate risk and cheaper borrowing costs. However, it also comes with drawbacks, such as potentially encouraging debt accumulation and exposing other countries to spillovers from fluctuations in the U.S. economy. Calls for alternative reserve currencies aim to reduce reliance on the dollar and mitigate its perceived dominance in global finance, potentially creating a more diversified and stable monetary system. The evolving dynamics of the US dollar's decline and its reserve currency status present challenges and opportunities for policymakers, central banks, and investors worldwide. Balancing the benefits and risks associated with these changes will be crucial in shaping the future of global economic growth and financial stability.